Hello, friends, and welcome to this interesting webinar. Friends, Nippon India has launched a very interesting product called Nippon India Nifty Alpha Low Volatility 30 Index. To talk about this new fund, we have with us Hemen Bhatia, head ETF at Nippon India Mutual Fund. So, friends, Hemen has over 15 years of experience, especially in passive funds. Hemen is among the first few professionals who spearheaded the passive revolution in India. So, without wasting time, let's welcome Hemen. Welcome, Hemen.
Thanks, Nishant. Thanks for inviting me for this webinar.
Okay. So, Hemen, as you know that Nippon India is going to launch Nippon India Nifty Alpha Low Volatility 30 Index Fund. So, what's the rationale for launching this new fund?
Okay. See, Nishant, that Nippon India Mutual Fund, our objective is to provide more and more choice to the investors. So, ideally, if you divide an investor's portfolio into core and satellite, okay, the core portfolio will have your beta products. For example, say Nifty 50 index or say Nifty Next 50 index, mid cap 150 index. Okay. So for the core part, we have one of the most comprehensive bouquets across ETFs and index funds, yeah, wherein a lot of choices can be provided to the investors. For the satellite part, okay, uh, uh, you can have satellite part will include say your AIF, PMS, stocks, active funds, etc. So on the satellite part, we currently have two funds. One is a NV20 index fund, and another is dividend opportunities ETF. Okay, so we are actually expanding our satellite part to provide this new option to the investors, which will help investors get a wider choice to build the satellite portion of their overall portfolio. Yeah, so that's the objective and the rationale for launching this product.
Okay. So, Hemen, there are a lot of opportunities when it comes to index selection today. Then why Nifty Alpha Low Volatility 30 Index?
Yeah, see, you rightly said there are a lot of opportunities. So if you see, there are various factors. For example, there are various strategy indices or the smart beta indices as they are called. So just to name a few single factors, there are factors like say quality, there are factors like low volatility, there are factors like momentum, there are factors like alpha, value. So there are multiple factors, single factors. Okay. What we have observed is a lot of these single factor indices, they are very cyclical. Okay, they tend to outperform in certain markets, then they tend to underperform in certain markets. The volatility is quite high and they are very cyclical. Yeah. So what we thought was, why not have a combination of two-factor index or say a multi-factor index, wherein you can combine two factors and avoid the cyclicality of the single factor. So as you rightly said, there are various four factors, there are various three factors, there are various two factors, and there are various single factors. Yeah. Uh, uh, Apart from that, what we did was to select this particular index. We even did a lot of this back testing. Okay, so we back tested almost some 17 years data from April 2005 to June 2022. And during that duration, we did the analysis of the rolling returns of various 1, 3, and 5 years observation. So we've analyzed almost some 3 to 4,000 data points, and our observation says that Nifty Alpha Low Vol has outperformed, has performed relatively well as compared to a lot of these four factors, three factors, single factor indices for almost 60 to 80% of the time periods. Yeah, across these observations, not only based on return, but even based on risk-adjusted return. So we even calculated the rolling risk-adjusted returns, yeah, to see how it has performed against various of the various four factor, three factor, and single factor indices. There also, based on risk-adjusted return basis, it has beaten. It has not. It has performed relatively well across almost 55 to almost 70 to 80% of the time periods. So that this is the rationale behind choosing this particular two-factor index as compared to various other four-factor and single factor available in the market.
So, Hemen, can you tell us more about the fund and why do you think that this offering is very unique to investors?
See, this is a passive fund, right? This is a passive fund. The objective of this fund is to track the underlying index. In this case, the underlying index is Nifty Alpha Low Vol 30 index. So our objective is to keep replicating the index at all point of time and keep the tracking error at the lowest. Given that this is a passive fund, it is very important to understand the index construction, okay, of this particular fund. So the index, which is Nifty Alpha Low Vol 30 index, it is constructed by NSE indices, and they have been running this index now since past couple of years. So to explain the index methodology in brief, I'll divide it into four parts. First part is about the index universe. From where do the stocks, where will the stocks be selected? So the universe for this index is going to be Nifty 100 index and Nifty Mid Cap 50 index. So a combination of large caps and mid caps is going to be the universe for this index. Once you have the universe, will apply the index provider applies the eligibility criteria. For example, the underlying stocks which are part of the universe, okay, they need to be part of the FNO segment, mainly from the liquidity perspective, and they even need to have at least 1 year history, okay, of performance. So those two filters are to eliminate the stocks out of the Nifty 100 and Nifty Mid Cap 50 universe. Once you have the stocks with these filters, then stocks are selected and selected based on the alpha score of each stock, okay, wherein the alpha is calculated based on the daily returns of the stocks, and the alpha which is calculated based on the Jensen's alpha formula. Second is the low vol component, which is again the standard deviation of the individual stocks which we are analyzing. So lower the volatility, higher the rank, and higher the alpha, higher the rank. Ultimately, a combination of alpha and lower, wherein you give index provider gives 50% weightage to the alpha score and 50% weightage to the low vol score. Based on that combined score, top 30 stocks are selected, which will form part of the index, and even the weightages of those index are given based on the combined alpha and lower score. Fourth thing to note is the index rebalancing. This index will be reviewed by index provider on half yearly basis, similar to most of the other broad market based indices. It will be reviewed at the end of June and September.
Okay.
June and December, sorry.
So, Hemen, equity, as we all know, that inherently is very volatile asset class. So, why are you confident that the fund would be less prone to volatility?
Uh, See, this fund, as I said to you, this fund will fit into the satellite part. Okay. So, in the satellite part, what you generally see is, as I said to you, the alternatives are say AIS, PMSs, active funds, and various other strategies, single strategy indices. So here the fund is not only choosing the stocks based only on the alpha. Okay, the fund is giving a equal weightage, that is 50% weighted to even low vol as one of the parameters for choosing the stock. So suppose if you have a stock which may be performing very well, okay, based on the alpha score, but not necessarily that it will be included in the index just because it is performing. Low vol has got equal weightage. So combination of both will work well, wherein you can say with alpha the investors will get growth, and with low vol investors can get stability. So it's a combination of growth as well as stability. And as I said to you, on relative terms, we have almost analyzed 3 to 4,000 observations, and this fund, this index has performed relatively well as compared to various other single factor and even 3 to 4 factor indices. So there's obviously no guarantee, but yes, seeing the backtested data as provided by the index provider, it provides stability as well as the growth to the performance.
So, Heman, you mentioned about FNO. It has to be stocks constituents has to be traded in FNO for at least 1 year. So, what is the benefit of it? I mean, this factor.
So what happens is, if any stock is part of the FNO segment, they are not prone to circuits, right? There will be circuits, but again, those circuits get relaxed within certain cooling off period. Okay, and unlike unlike a lot of stocks who do not have FNO,
Hmm.
there they have circuit filters, and if a particular stock reaches a circuit filter, then the underlying fund, if it has to buy or sell that stock, it will not be able to do it, right?
Right.
In case of FNO stocks, funds can easily buy and sell the stock at any point of time without fearing the circuit filters. Yeah, circuit filters are there,
Hmm.
but because of the FNO criteria, they get relaxed within the cooling off period.
Okay. So, Hemen, currently the underlying index has over 31% weightage to FMCG and around 10% each to IT and healthcare. So, don't you think that this composition of index will increase the concentration risk?
Uh, See, if you see historically also,
Hmm.
fund selects the underlying sectors, I'll say, are a outcome, okay, of the index methodology, and there is no stock selection or sector choosing or which is done by any fund manager here. This is a passive fund. So based on the methodology, today FMCG is commanding say 31% weightage, IT and healthcare is commanding 10% weightage each. Power, chemicals, and financial services, they have around 7 to 8% weightage. And if you see the overall sector, there are around 14 sectors which again in which the various index constituents are divided. So the sector allocation is the outcome of the index methodology. Sectors will keep on changing. Today it is FMCG, tomorrow it may be some other sector which will score well based on the alpha and lower scores of the underlying stocks, which will be which are chosen from the universe. So today it is one sector, tomorrow it may be any other sector. But important point to note is it is the sectors are not chosen. They are just the outcome of the index methodology,
Hmm.
and with that outcome, important point to notice, with those outcomes across years, across the back testing which is available on public domain, how has the index performed historically?
Hmm.
Yeah. So with the same methodology, as I said to you, index has performed relatively well as
Hmm.
compared to various other single and multi-factor indices, which means the methodology is doing its job, which it is required to do in terms of providing growth as well as stability in the performance of the index.
Okay. So, Hemen, what are the other key risks associated with fund?
See, as I said to you, this fund will fit into the satellite part. So let me tell you, anything other than market beta, which is your core market cap based indices like say Nifty 50, Next 50, Mid Cap 50, which work on collective wisdom. Okay, this fund is working based on certain parameters as decided by the index provider, which is your alpha score and your low wall score. So any deviation from market cap index, you may either outperform the overall market or you may underperform the overall market. So obviously those risks are common while you invest in any other active fund as well, or while you invest in AIS, PMS, or while you choose any stock. So any deviation from market cap based index, the chances are there that you will outperform or underperform. So that is the only risk which investor has to keep in mind. Hence, while we started, I said to you, this will fit into the satellite portion of the investors portfolio, wherein investors are looking at market plus returns, they are looking at beta plus returns, right? So the expectation is that of beta and market plus returns, only those investors should go ahead and invest in this fund as part of their satellite portfolio.
Okay. So, Hemen, one last question. So we all know that passive funds offer low trail commission to MFDs. So how do index funds make business sense for advisors?
Sure. See, it's a very valid question. So what happens, Nishant, is a lot of clients today, because there's so much of information available in social media, a lot of them have become DIY. Okay, they are all do-it-yourself investors, wherein they go ahead and invest in the, say, ETFs, or they go ahead and invest in the direct plans of active funds or say index funds. Yeah, if a distributor is able to construct today, in today's world, I'll say a distributor will be able to construct a basket,
Hmm.
okay, of products out of the passive fund, because there is a lot of choice which is available today in passive world across equity, fixed income, and even commodity, and even the commodity as an asset class. So ideally, if a distributor or say advisor if they construct a all passive portfolio for the investor based on their advice and based on their knowledge, it will actually help the client basically achieve better returns, or say better risk adjusted returns based on their advice. So it's a win-win for both, right? A client will get good advice, which in other case, if they are going into the direct plan, they won't get. At the same time, a distributor who is already losing out that client to a direct plan, okay, because they are providing a valuable advice, and they will actually be able to retain that client, and they can actually earn a trail commission in by basically investing clients' money into say any of these passive index funds.
So, all right. Thank you so much, Hemen, for such an insightful discussion. All the best for the fund.
Thanks, Nishan.
Thank you. Finally, I thank each one of you for being such a wonderful audience. Have a lovely day, guys. Bye.